A colossal spending measure, one that critics are calling a $500 billion government handout, is set to expire.
Right, at the end of December 2025.
And if Congress fails to act, millions of Americans face this immediate and frankly brutal financial cliff.
Skyrocketing health insurance premiums.
Yeah, and this whole situation is, I think, the perfect, painful illustration of how these temporary government solutions, they often create permanent and really exposed dependencies.
It is absolutely the defining fiscal and consumer crisis looming on Capitol Hill right now. We are talking about the Enhanced Affordable Care Act premium tax credits.
The ACA subsidies.
Exactly. These credits, they temporarily expanded who is eligible and dramatically increased the generosity of the subsidies for people buying insurance on the ACA marketplace.
Okay, let's unpack this for you, the listener. We've done a deep dive into the source material, and it lays out a truly staggering scenario.
It's not just some political skirmish.
No. This is a policy design failure ticking down to a fiscal deadline. If Congress lets these enhanced subsidies just sunset at the end of 2025, subsidized enrollees are going to see their average annual premium payments more than double.
That's the core statistic we really need to focus on, a projected 114% average increase.
114.
Yeah. Right now, after the generous tax credits, the average annual premium payment is around, what, $888?
Okay.
Come 2026, that payment is projected to jump to almost $2,000. $1,904 to be exact.
That's a massive spike.
A massive spike.
Yeah.
And it's a direct consequence of a policy that was, explicitly designed to be temporary.
And that temporary part is the root of the whole political conflict, isn't it?
Absolutely.
On one side, you've got Democrats pushing hard for a costly long-term extension. Some proposals are talking 3 years. Some are even saying make it permanent.
And on the other side.
On the other, you have Republicans focused squarely on fiscal discipline. They're arguing pretty adamantly against turning what was sold as a crisis-driven COVID-era measure into a massive, permanent, new entitlement program.
So our mission today is to really dissect the numbers behind that conflict.
Right.
We need to analyze the true fiscal cost of this extension, which could hit nearly $500 billion over a decade, and then expose the structural flaws in the subsidies themselves.
The argument being that they primarily fund insurers and the well-off.
Exactly. And finally, we'll look at the market-based solutions that conservative critics are proposing to tackle the real issue here.
Which is the underlying cost of healthcare.
Precisely.
That is the crucial question, isn't it? Are we just going to keep paying ever-increasing insurance bills with taxpayer dollars, or are we going to address what makes those bills so expensive in the first place?
To really understand this cost shock, you have to start with the political mechanics.
Okay.
These enhanced premium tax credits, the PTCs, they were never part of the original 2010 ACA.
No, they came much later.
Much later. They were injected in 2021 by the American Rescue Plan Act, and then later extended by the Inflation Reduction Act through 2025.
And the sources are really clear that this expiration date wasn't just some arbitrary thing. It was a condition of using a special legislative tool, right?
Precisely. Both of those acts were passed using what's known as budget reconciliation.
For listeners who might not be familiar, can you explain what that is?
Sure. Reconciliation is a special Senate process that allows certain spending and tax measures to pass with only a simple majority, so 51 votes.
And that bypasses the need for the typical 60-vote filibuster threshold.
Exactly. It's a political shortcut.
But it has a major limitation.
It does, a major fiscal one. Reconciliation rules say that a policy can't significantly increase the federal deficit over a 10-year window.
So to get this massive multi-hundred-billion-dollar spending measure scored favorably by the Congressional Budget Office, the CBO,
they had to give it a tight expiration date. That expiration date was a structural necessity. It was designed to, frankly, hide the true long-term cost from the CBO's official score.
And this is where the rubber meets the road.
Hmm?
The consequences of using that temporary fix become brutally clear. Let's look at the actual sticker shock that's detailed in the analysis if this government funding tap is turned off.
It really reveals just how deep the financial dependency has grown in just 3 short years.
Let's look at an example from the data.
Okay. The first one is a 60-year-old couple making $85,000 a year.
So an income level just slightly above where the original subsidy cap was.
Right. If the enhanced credits expire, the sources project their yearly premium payments will rise by over $22,600 in 2026.
$22,000. I mean, that's not just a big number. That's like a second mortgage payment just appearing out of nowhere.
It would bring their benchmark plan payment to about a quarter of their annual income.
Up from 8.5% today, the fiscal shock is just immense.
And it's not just high-income couples either.
No.
Individuals making modest wages are also facing a dramatic loss of support.
Right, because the subsidies become less generous overall.
Exactly. So an individual making $28,000, for example, would see their annual premium contribution jump from around 1% of their income, about $325, to nearly 6%, $1,562 a year.
So that's an unexpected expense of over $1,200 for someone who is already, living paycheck to paycheck.
And as if that policy cliff wasn't enough, we have this compounding issue.
The timing is terrible.
So it's a perfect storm. The expiration of this huge funding boost coincides with rapidly rising underlying healthcare costs.
And insurers in the ACA marketplace, they're already proposing a median rate increase of 18% in 2026.
18%. That is the largest proposed increase since 2018.
So the enhanced credits have basically been a veil.
A huge veil, yes, masking underlying inflation in the healthcare sector. When the subsidies vanish, you're not just losing the government's help, you're also facing the full force of premiums that are 18% higher than they were.
And the subsidies were never designed to fix those costs, only to pay for them.
Exactly.
Okay, let's shift now to the structural critiques of the subsidies themselves. I mean, the argument that this entire system is fiscally wasteful and poorly targeted.
Right.
One of the primary conservative objections is that eliminating the income cap means this whole measure just funds the well-off. Can you clarify what that cap was and why its removal is so controversial?
Certainly. So, before the American Rescue Plan Act, the original ACA placed an income cap on who qualified for subsidies.
And that was
400% of the federal poverty level, or FPL.
Which today is about, what, $125,000 for a family of four?
Roughly, yes. The temporary expansion eliminated that cap entirely.
So what was the consequence of doing that?
It meant that, depending on the cost of the benchmark plan in your region, high-income earners, and the sources highlight households making up to nearly $600,000, could suddenly qualify for these generous government benefits.
600,000.
Yes. The subsidy formula calculates premiums based on a percentage of income. So if a high-earning family lives in an area where health plans are exceptionally expensive, the government just covers the difference.
Regardless of their total wealth.
Regardless.
And the data confirms this is actually happening across the board.
Absolutely. The data is clear. Roughly 1/3 of the boosted subsidies are directed toward people with incomes above that 400% FPL line.
A third.
A third. So critics argue this demonstrates a massive failure of targeting. Taxpayer money is flowing disproportionately to affluent people and families who could likely afford coverage anyway.
Which really undercuts the claim that this is solely a crisis relief measure.
It does.
Okay, here is where it gets, I think, really interesting and, frankly, a bit suspicious. We keep calling this a subsidy for patients, but the funds don't actually go to the patient's bank account.
No, they go directly to the insurance companies.
So if we are pouring potentially $500 billion into this system, what does that actually do for the insurance industry?
Well, critics argue that the entire structure is basically designed to benefit the middleman. By subsidizing premiums directly, the insurance industry is essentially given a blank check to shift the majority of rising premiums onto you, the taxpayer.
So there's no incentive for them to control costs?
None. The government ensures the bills get paid.
Do we have metrics to show how much the insurance industry has benefited from this whole arrangement?
We do, and the numbers are just striking.
Okay.
Since the ACA subsidies were first implemented, health insurer stock prices have increased more than 1,000%.
1,000.
1,000%. For comparison, the S&P 500 grew by about 250% in that same period.
So when you look at that 1,000% growth, the conservative argument is pretty forceful.
It is. They say the primary beneficiary of this massive spending isn't the average patient, but the corporate bottom line. It's padding profits, not fundamentally fixing healthcare costs.
That puts the proposed $355 billion extension into a totally new light.
It does.
It sounds like Congress is debating whether to fund the continued massive growth of an industry that has clearly figured out how to profit immensely from this subsidy structure.
That's the key critique. And the fiscal irresponsibility only deepens when you start to examine the evidence of waste and fraud within the system itself.
Okay, tell us about the fraud statistics detailed in the source material.
It's a huge liability for taxpayers. A recent report estimates the program suffers from 6.4 million improper enrollees.
6.4 million, and that includes, what, people who reported false information.
False information or are otherwise ineligible. And that's costing taxpayers an estimated $27 billion in 2025 alone.
27 billion in waste this year. Wow.
And then there's this strange phenomenon of what sources call phantom enrollees. They highlight that 11.7 million enrollees, that's over a third of the entire market, have filed zero claims for their heavily subsidized insurance.
Wait, so taxpayers are paying insurance companies tens of billions of dollars for coverage that people receive but never actually use.
That's right. The money still flows out of the Treasury and into the insurance company, even if the coverage is never utilized.
Why would someone enroll and then file zero claims?
Because for many, the cost is so close to zero thanks to the generous subsidies. They enroll because the government makes it available, but if they're healthy or just don't value the costly high deductible plans that much, they never engage with the system.
And this leads directly to the core conservative argument for letting the program expire.
It does. The CBO estimates that if the subsidy disappears, 3.8 million Americans would simply choose not to purchase insurance in 2035.
That 3.8 million figure is powerful. It implies that millions of people don't actually value these government-mandated plans enough to pay the real price for them.
And continuing to force taxpayers to pay for coverage that millions of recipients don't even use is, well, it's very difficult to justify as fiscally responsible.
Well,
So now we get to the political calculus. Democrats want a permanent or at least a long-term extension. But the price tag of permanence is simply astronomical for fiscal conservatives.
right.
Permanently extending these expanded tax credits is estimated to add approximately $355 billion to the budget deficit over the next decade.
And when you factor in the additional interest costs to finance that new debt, the total cost for taxpayers jumps to nearly $500 billion.
It's a staggering number.
And that's why the 60-vote threshold in the Senate and the Republican focus on fiscal discipline is so critical here. They are determined to prevent a temporary crisis-driven measure from becoming a permanent expansion of government spending.
And beyond the sheer cost, there are these deep ideological roadblocks that prevent any kind of bipartisan compromise.
Like what?
The sources highlight the Hyde Amendment as a major, difficult, challenging issue that just cannot be ignored.
For our listeners, the Hyde Amendment restricts federal funding for abortion services. How does that play into the ACA subsidy debate?
Well, Republicans are committed to ensuring that Hyde protections apply to ACA policies, meaning no federal money can fund abortion coverage through subsidized plans.
And Democrats have historically opposed applying those restrictions across the board to the ACA.
Correct. So it's not just a spending debate. It's a deep moral and policy disagreement that acts as one of the biggest obstacles to finding any consensus solution.
So if fiscal conservatives refuse to extend this entitlement because of the cost, the poor targeting, the fraud, what's their alternative?
Right.
They can't just walk away and leave millions of people staring down a 114% premium spike.
That's why the Republican vision centers on structural reform. It's aimed at reducing the underlying cost of healthcare rather than just subsidizing the symptom, which is the high premium.
So they're advocating for immediate market-based alternatives. Let's start with health savings accounts, HSAs. How would conservative proposals use HSAs to address this crisis?
HSAs are seen as a tool for consumer empowerment.
And they have tax advantages.
Big tax advantages. One proposal seeks to shift the subsidy money directly into these tax-advantaged health savings accounts for people who use bronze plans.
Bronze plans typically have low premiums but high deductibles, right?
Exactly. The current subsidies cover the low premium, but leave that high deductible as this massive hurdle for people.
And the HSA money would help bridge that deductible gap.
That's the idea. This approach reduces the high premium cost while simultaneously giving individuals tax-free funds that they control, which they can then use to cover those deductibles.
So it encourages people to shop for cost-effective care because it's their money.
Precisely. It shifts people into less expensive plans, and it gives patients more control over their own health spending. It shifts power away from the insurance company.
And the other major structural idea focuses on competition and scale, right?
That's the second pillar, expanding association health coverage.
What's that?
The idea here is to allow individuals and small businesses to pool together across state lines. They can join large associations. Think of groups like Costco or national trade associations to offer policies
How does that mechanically reduce cost?
by creating much larger multi-state risk pools. When you move people out of the often volatile and expensive individual market and into a huge pool, you achieve massive economies of scale,
It lowers administrative costs and increases buying power.
significantly, allowing these large groups to offer policies that are dramatically cheaper and more tailored than the current government-designed ACA plans. It's a reform that uses market competition to address affordability.
It really illustrates the core philosophical disagreement, doesn't it?
It really does.
One side believes the answer is spending hundreds of billions to prop up a fundamentally expensive system.
And the other believes the government should instead foster market competition and individual empowerment through tools like HSAs and interstate coverage to make the system less expensive in the first place. So this deep dive really shows that Congress is facing a zero-sum choice in late 2025.
It seems like it.
They have to decide between sustaining a temporary $500 billion spending measure that critics argue primarily benefits the insurance industry and high-income earners,
Or ending the measure as planned and forcing a real debate on structural, market-based reforms.
like expanded HSAs and genuine interstate competition.
The fiscal arguments against just extending it are potent. They're backed by CBO estimates detailing ramping fraud, poor targeting, and $355 billion in new debt.
Right.
The question lawmakers are struggling with, and you should be considering as you process these numbers, is this.
Is avoiding a self-inflicted political crisis worth perpetuating a temporary crisis-era program that is demonstrably rife with waste?
Or should lawmakers seize this deadline as an opportunity to focus on alternative proposals that truly foster competition and restore some fiscal responsibility to American healthcare?